And ladies and gentlemen, moving on to the next sessions with the topic Strengthening Industrializations for Indonesia's Economic Transformations. And I would like to invite the moderator, Mrs. Della Temenggung from Prospera. Dipersilahkan.
Yeah. Good afternoon. Oh, is it? Okay. Thank you very much. Thank you very much for BKF for inviting me to moderate this session. We had a very interesting, insightful presentation from Pak Sua to set the scene for this session. So let me first calling the two speakers to join me on the stage. Our first speaker is David Woods. Mr. David Woods is now the Senior Treasury Representative from the Australian Embassy in Beijing, China, please. And our second speaker, Jesus Felipe from the Asian Development Bank. Please join me to the stage. Before I start and introduce further our two speakers, as Pak Sua mentioned earlier, so this session will discuss a bit more on one of the key areas that I think has been discussing since the morning with the minister and then Professor Lawrence and then Pak Sua also bringing the importance of how we could strengthen the industrialization for Indonesia's economic transformation. And in this session, we would like to explore one area where we can get a lesson learned from China's experience in this area, focusing, of course, on the how they could improve their productivity, opening up their economy, significantly sort of like transform the manufacturing sector, but then later on also how the services sector and they could then increase their capacity to engage in the digitalization and contributing more on the broader economic transformation of China. So let me invite our first speaker, David Wood. Please, stage is yours. 30 minutes, please, so we can have more interesting discussion after this.
Well, thank you, Della, and thank you to the BKF for inviting me today. This is my last week as the Senior Treasury Representative in Beijing, and so spending my last of that time after 4 years in China, spending my last week here in Bali is a pleasure that is unexpected. In fact, let me say it's doubly so. So 4 years in China have been dominated by concerns and questions about the outlook for China, about whether there is a slowdown, a hard landing for China, about the risk of a financial shock emerging from China, and of course in more recent times about the economic consequences of the trade dispute between China and the US. So it is a pleasure to take a different focus, to step back instead and reflect on the successes of the Chinese economy over a longer time frame and the lessons that it might offer for other countries, including, of course, for Indonesia. I should add two disclaimers. The first, of course, I can only speak with authority about the Chinese economy and claim no knowledge on Indonesia. So, in fact, I'm learning much from today's conversation. But for the purposes of comparison, with my charts I will follow, I have added Indonesia to support a discussion that can follow in terms of the compare and contrast with China. And of course I should add, as a government official, that these are my own personal views. So they're not those of the Australian Treasury and they're not those of the Australian government. So this month, December 2018, marks the 40th anniversary of the era of reform and opening up in China. Something that the Chinese authorities have been marking through the course of this year as a reminder of the benefits of liberalisation, a message all the more pointed and a message all the more significant given the current trend towards protectionism. So some people have struggled here. Hopefully, yes, that works. So we've talked about China a lot today, and for the obvious reason which is set out in this chart, which has been the success in lifting per capita GDP as a measure of living standards. So going back as far as my data permits, which is effectively the start of the reform and opening up period, let's call it 1980, and we can see from 1980 until 2017 that in real terms, per capita GDP rose by over 2,000%, which is clearly a success story that we need to learn about. Of course, a average GDP or per capita GDP does not tell us about the distribution of income in China. Growth has been shared, yes, which has resulted in the largest fall in poverty in history, which is clearly a magnificent accomplishment, but it's not been shared equally. China has moved from being a moderately unequal society in 1990 to being one of the most unequal countries in the world. In 2013, the Gini coefficient, as merely one indicator of inequality, in China was 47 Gini points. As the chairman just spoke, bringing this back is a difficult task, and there has been signs of that coming back since 2008, but progress has been very modest. Now, inequality of the scale has political and social dimensions that I don't plan to address today, but it also weighs on future growth. So the IMF has been at pains to make recommendations to the Chinese authorities to build a tax and transfer system to support the rebalancing of growth towards consumption. Indeed, this is an issue that a topic that we have been talking closely with our colleagues in the Chinese government agencies. I should also add this chart, amazing as it is, does not take account of the cost to the environment from the rapid industrialisation of China. The negative externalities of air, sea, and water pollution are not priced. They're not factored in and they're not accounted. But from somebody who's lived in China for 4 years, they are very, very real. However, like distributional issues, the environment has been rising as a political priority for the Chinese government, with Xi Jinping last year nominating this as one of his 3 critical battles. So, negative externalities to one side, the question though still remains is, how did China do this? How did they grow so fast? And what lessons can we draw from their experience? So this morning we talked a lot about productivity, and obviously for good reasons. So if we look at the Chinese productivity experience, China being the blue line, Indonesia being in red, you can see a pattern of extremely strong productivity growth over a sustained period of time, which from the start of the reform and opening up period through to the end of this, or the start of this decade. And there have been some downturns along the way, which reflect the economic cycle, which reflected the economic cycle in China. But the point remains that over a sustained period of time, there was a pattern of extremely strong productivity growth. And this was very much the dividend of policy reforms to liberalise the economy. The economic strategy that predated this period, the economic strategy that predated the reform and an opening up period, sought to promote industrialisation of China by mobilising resources and allocating them to favoured sectors, particularly heavy industry, through central planning, and by doing that in an economy that had minimal exposure to the global economy. Yet, China's per capita income relative to that of the developed economies had gone backwards compared to where they were in the early 1950s. Even, and we talked a lot about demographics, even in the face of the demographic dividend that started to emerge in China from the 1960s. So they had some of the conditions that we've been talking about here in Indonesia, but their policy response was a failure. And that really, had the benefit of priming China, at least, for rapid catch-up growth when it had the right policy settings in place. So the reforms that started 40 years ago had a dual focus. On the one hand, it was about opening up, or introducing, I should say, market signals into the planned economy. So that's on one hand. On the other hand, China opened up and engaged with the global economy. So as I said, a dual track strategy. At the heart of the domestic reforms was the restructuring of the SOE sector to orient the SOEs, to orient them to the market, and to introduce, and indeed to encourage, competition from non-state enterprises. In parallel, so two tracks, in parallel, the economy started to open to foreign trade and investment, famously starting with a trade zone in Shenzhen, which at the time was a fishing village of 20,000 people, today 15 million people. Starting with a free trade zone in Shenzhen, and ultimately leading to accession to the WTO at the end of 2001. Now, at that time, that was a controversial decision within China. There was a lot of fears within China that accession to the WTO would mean that the local economy would be swamped by foreign competition, which is, of course, somewhat ironic. Instead, the export sector boomed, with exports growing by 24% each year on average in the period leading up to the financial crisis, which lifted the trade intensity of the economy, so exports and imports combined as a share of GDP, lifted the trade intensity of the economy from less than 10% to a peak at 57% just before the crisis. It peaked in 2006, and it actually has been falling since then to a level that's now only just north of where the US, as the other continental-sized economy, is. So there was some observations in the sessions we had this morning about the reliance of China on net exports as a driver of growth. That's no longer the case. That was true 10 years ago, but net exports has not been a contributor to growth on a sustained basis since then. So the reforms delivered the strong growth in labour productivity as labour shifted from rural underemployment to urban manufacturing. Market forces delivered productivity growth within each sector, so that was a function of capital deepening and better management. But labour mobility between the sectors was the single biggest driver of productivity gains over this period. The share of the labour force, so coming back to a point that the chairman made, but also we heard this morning from Professor Lawrence, the share of the labour force working in agriculture fell from over 68% of the labour force in 1980, 68%, to less than 37% within 30 years. I just pause there for 1 second. So the productivity, I would say that the productivity gains were driven by taking farmers and putting them into factories. But that glosses over the gains that occurred within each sector. And to take agriculture as the leading example, the biggest driver of productivity in the China agricultural sector occurred when some farmers in Anhui province, which is still one of the poorer provinces in China, but where the farmers broke the law. And they broke the law because they moved away from a requirement to of communal farming to taking their produce and selling them and retaining the profits. That was breaking the law, and yet it was tolerated by the authorities, and as they saw the benefits on productivity, then that allowed them the political space and gave them the reason to change the law and to allow this to spread throughout all of mainland China. So the shift in the industrial structure of the Chinese economy, of course, also drove the urbanisation of China as the migrant labour moved to the growing cities to work in the factories. China started spending more on urban infrastructure to support this movement. The establishment of property rights, so remembering we're coming from a communist system that really had none of the infrastructure, the social and policy infrastructure that Indonesia has today, did not have property rights. They were only established in the late 1980s. The establishment of property rights for urban households translated this movement of people into growth of the Chinese property sector, which has since developed into one of the major features of, and one of the major risks to, the Chinese economy. This virtuous cycle meant that China took advantage of its demographic dividend in a way that it failed to do with its policies of central planning. China's falling dependency ratio contributed significantly to the development of the economy through much of this period. The availability of labour supply, of cheap labour, was one clear and obvious benefit, but it was not the only one. The low dependency ratio also contributed to China's high savings rate, which certainly financed the capital accumulation, the investment in the manufacturing sector, the infrastructure and the cities that drove these gains in productivity and living standards. So it's worth noting that there was a clear lift in China's savings rate. You can see it bumping up there, starting from the late 1990s and peaking at 52% of GDP in 2008. And that was household savings. It wasn't corporate savings, it wasn't government savings, that was household savings. And the driver for that were the major reforms of SOE sector in China at the time under Premier Zhu Rongji. Very painful reforms of the SOE sector. 30 million people lost their jobs. And that was contributed to that lift in the savings rate, which we think of as precautionary savings, as Chinese workers suddenly were stripped of what was previously their social security network, the social network, safety network. And these domestic savings, much more than foreign capital, as important as foreign capital was as a source of innovation, but these domestic savings financed China's rising level of investment. However, as you saw in that previous chart, if you can think back to, I don't want to take my chances with this, but if you can think back to the previous chart, those productivity gains in China that were so strong from 1980 to 2010, 30 years of productivity gains, have slowed since the start of this decade. So this is not a surprise. We've heard John mention the reversion to the mean this morning. And I think this is an example of what we're seeing. Productivity growth in China, it certainly remains high relative to advanced economies that have struggled to generate gains since the financial crisis, but the gap is shrinking. As I said, this is intuitive. The productivity gains are harder to find as a country gets closer to the frontier, while the rebalancing of the Chinese economy towards the service sector, which is now more than half the economy, will also be a drag on growth, as international experience would show that productivity gains are harder to find in the service sector relative to manufacturing. It's worth noting also that China's working age population peaked in 2001, so its dependency ratio has started to grow again. In other words, the demographic dividend for China has peaked. Productivity and working age population are both trending down, which suggests that China's potential rate of growth has started to decline from the start of this decade. So I want to pause at this point in the narrative to reflect on the first lesson that I would take from the Chinese experience. And it's very simple. Is that China unleashed market forces and opened to the world to deliver gains in productivity and living standards that central planning and industry policy and protectionism had failed to do. Demographics helped, particularly by generating a pool of savings that could be deployed in the process of capital deepening. Some of these savings were deployed in building cities, but the rest were deployed in building a manufacturing sector, but in response to the price signal rather than policy. So, to return to my narrative, 10 years ago then marked an inflection point in the growth potential in the Chinese economy. Coincidentally, I think coincidentally, it also marked a different turning point, that is in the terms of the drivers of growth, as China responded to the global financial crisis with its famous stimulus package. You'll be familiar with the story, so I'll be brief. Chinese exports contracted by 16% in 2009 as a result of the recession in its key markets in the North Atlantic. Chinese policymakers moved quickly to fill the gap by supporting domestic demand through a fiscal stimulus package of roughly 10% of GDP. The Chinese fiscal stimulus was primarily delivered through investment in infrastructure as the most direct channel into the real economy, in the absence of the sort of tax and transfer system that was used to support consumption in the stimulus packages deployed by or set out by developed economies. But the direct fiscal stimulus was only a small part of the story. Much more support came through quasi-fiscal support directed through the state-owned banking system. The central bank moved quickly to ease monetary conditions, and the state-owned banking system was encouraged to allocate credit to support business investment, particularly by state-owned enterprises. Restrictions on the property sector were relaxed to unlock further support for the economy. So this chart on investment shows the effect of these measures very clearly. You can see, again, China being the blue line, you can see the lift in investment in 2009, 2010, which was from already high levels to peak at 48% of GDP. Investment accounted for 87% of growth in China in 2009 and 66% of growth in the following year. So the stimulus worked, at least in its primary goal of supporting the economy in the face of an external shock. However, this chart also shows you that investment has only partially retraced that level shift increase. Indeed, the Chinese policy makers have continued to rely on those same set of tools, so fiscal investment in infrastructure, rapid credit growth, alternate tightening and easing of restrictions on the property sector to manage the business cycle in China since then. So, a few observations, 3 observations. Leverage. The high levels of investment in China since the financial crisis has been financed by a lift in debt. China's macro leverage in 2008 was 141% of GDP. 9 years later, it was 256%. That's quite staggering. Let me say it again. 141% of GDP to 256% of GDP in just 9 years. Now, the level of debt is not particularly high when compared to developed economies such as the United States or Japan, or for that matter, Australia. But it is very high by the standards of emerging economies, and in the context of an economy that faces the demographic pressures such as China. This debt, as I was saying, has accumulated extremely rapidly, and the IMF through their Article 4 reports, have continuously noted that previous examples of such growth in leverage, such rapid growth in leverage, has generally resulted in a banking crisis or a sharp contraction in growth. The sustainability of this pattern of growth, built on debt, has therefore been an increasing concern. Most of the debt is financed domestically on the back of that savings that I showed in the last chart. And so China has very limited financial currency liabilities, which provides some source of comfort that the authorities have the resources to manage any emerging crisis. Nonetheless, Xi Jinping nominated deleveraging to be one of his 3 policy priorities, 3 critical battles, and this has had some initial success in at least stabilising macro leverage. And you can see that at the end of this chart where it flattens out. However, this deleveraging, or de-risking, I think is a better term, this de-risking campaign is weighing on growth in China, just as it faces another trade shock, this time from the trade dispute with the US. Second observation, and that's around external rebalancing. So investment has drifted down slowly from the heights of 2011, that's my last chart, but national savings have come down faster as demographic change affects savings by households. And this is a function of, at both ends of the life cycle. Older people are now moving into retirement and drawing down their savings to finance their retirement. Younger people, particularly the people who are living in Shanghai and Beijing and in the urban cities where they stand to gain or inherit property from 2 sets of grandparents, don't have the same incentive to save as their previous generations. So savings rates are falling. And this has meant a rebalancing of China's external account, with the massive current account surpluses of the period prior to the financial crisis now reduced next to balance. Indeed, China ran a current account deficit in the first 3 quarters of this year, for the first time since 1993. This suggests that China will increasingly be forced to choose between sustaining current levels of investment or balancing its current account through a combination of either higher savings or lower investment. Either way would result in a lower rate of growth. In short, China is now facing a choice between a current account balance or a lower rate of growth. My third observation is around quality of investment. So the sustained high rates of investment that we've seen since the crisis have invited questions about the quality of the assets. Measures of increasing credit intensity. Measures of increasing credit intensity of growth at the very least suggest diminishing returns on investment, with some commentators going further to demonstrate that the stimulus-led investments as detracting from total factor productivity. My comments on the various categories of investment and my comments on digitalisation, I think we might have to come back to in the Q&A session. But let me conclude with what I would see as the second lesson from China's experience, which has been focused on this last decade of growth. And that is, China's growth potential started to decline just as an external shock forced a rebalancing towards domestic growth drivers, primarily investment. That sustained headline growth above where we might expect potential growth to be, but built on a rapid rise in leverage. China's been able to finance that domestically on account of a very high rate of domestic savings and restrictions on the outflow of capital. But this has diminished discipline on project selection that might have otherwise moderated that level of investment. These conditions may not be unique to China, but they're certainly not common. My point would be, this is not a growth model for everybody, and based on the little that I know, I'd suggest it's not a growth model for Indonesia. And even for China, the falling savings rate suggests that this growth model will be constrained in the coming years. So I'll cut short there, but I would certainly be happy to take up Q&A when we get to that point.
Thank you. Thank you, David. Thank you very much, David. Before I call Jesus on stage,